Hello, everyone. Welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Dutch Bros Incorporated, ticker BROS. This is the coffee chain, and there's been a lot of talk in the coffee space, especially with Starbucks appointing a new CEO, the previous CEO of Chipotle. Dutch Bros was one of the stocks with the most volume. There were a lot of billionaires who were buying into it. So we're going to take a look and see why people might be buying, what a fair price to buy would be, and what some growth prospects are. So to start, this is the company heavy into the investment stage right now, trying to open more locations, build their brand, because they've been running negative on cash flows and have had some pretty bad earnings as well, but are starting to enter a pretty good point where we're actually seeing some sort of value coming from them. I mean, right now I'm coming up with a fair value of 2 cents, discounted cash flows of negative $2.21 because they did have negative cash flows for the last few years. Earnings yield 0.02%. We'd like to see them come in with $1.63. That's not happening anytime soon. They're going to come in the 40s for the next 2 years, according to analysts. One in the low 40s, one in the high 40s. That's 40 cents. Cash flow yield, negative 9.17. They're usually around negative 7.5. So they did end up spending a lot more money this last quarter. Do not do a dividend. ROE low at less than 0.5. ROA 0.1. ROI negative 0.7. Not the best returns in here. But it still looks like it's early days into these investments. It may pay off in the future. Debt to equity, they're almost at 3. So we'd really like to see them pay down debt or really raise their assets. I mean, from what we're seeing, they're not really paying down debt, but their asset growth far outpaced their liability growth in the last year. Margins, gross margin of 26%. That's okay. Usually it's around 29.2. That's something better. 30 is ideal. Net margins, they essentially broke even this last year. They've been losing money for the last few years. And if they're coming in with 30% gross, I mean, 5% net at least is what we should be seeing out of them. And now, when we get to that point in our thesis, we can adjust things a little bit. But revenue growth, analysts are expecting huge growth. They've had huge growth. They're opening locations everywhere. They're issuing shares to get the money to do so, and also issuing debt. So for revenues, we're going to say 25% over the next 5 years. Share count, 15. I'd like to see that lower, ideally none, but they are in a big growth phase right now. Cash flows, it's only negative because they're starting out negative. This will actually bring them to almost break even in the next 5 years. Asset growth, right in line with what we've seen, 47, 48%. Liabilities, they cut it way down this last year. Even if it bounces back midway between these two, we'd be talking 32%. If it holds down at this point, they don't pay a dividend. Margins, actually, I think that they could do a bit better margin-wise. Because 2%, we're only looking at 0.2. They're starting off with a really small number, so maybe 20% would be better. That's 0.44 in 5 years. Let's try and get them up to 1% over the course of the next 5 years. We'll take that 1.35%. That's 50% annual growth in the margins. Probably capable of doing so, not them going positive. And for this, I mean, it's just overvalued right now for its current fundamentals. Buying in at today's price, you're getting incredible returns because revenue growth is crazy here. The cash flows, if they can get that towards positive, that's some massive growth for them. Huge, huge growth in the assets. Like, they're in the building phase, and this building phase is crazy for the valuation of the company. 255% annual returns. 255% annual growth in the fair value of the stock. But you're starting at 62 cents for your fair value. So It looks like a massive number, but at the end of the day, we're talking 2.5x. Even starting at today's valuation, doing that for 5 years, you're still not up to what you're currently paying for the stock. Because in 5 years, we're looking at a fair value of just shy of 24.5. That is above the 52-week low, though. So 23 may have been a decent spot to buy in. We can change this to the 52-week low and see how that impacts things. Yeah. You're looking at a return now in 5 years, 8% return. Still significantly underperforming the market. So I'd watch for a pullback and some outperformance of this scenario, but this is a really huge scenario here. 25%, 47%, 15, 50. That's massive. We can look at all of the valuations graphed out, see where we're getting growth from. Cash flows are pretty flat. Fair value slowly trending upwards. The earnings are pretty flat as well. Balance sheet definitely has some nice growth with that asset build that they're currently on. And then the actual share price is just bouncing all over the place. So at the end of the day, I definitely see the potential here for the stock. If they can continue at the growth rate that they're currently at, especially for the sector that they're in, they got some harsh competition, but it is a legalized drug. I just think it's at super elevated prices. This is a growth stock, not really a value stock. I'd be interested to watch it, see if it pulls back any more. I mean, below 25 may be an okay place to get in if you plan to hold it for the long term. Because it's at such a massive growth rate that you're trading at multiples a few years out for sure. We're talking about 5 years from this point. If they can continue with how things are going. And there's a lot of risk to that. Not really for me. I can see why people would be buying it up. I would, at a minimum, look for positive cash flows before I start buying. But we'll have to see how late I would be to the game at that point. So I want to thank you guys for watching. Please like, enjoy the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.